The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
September starts with a sell-off. Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Eric Balchunas. We're kicking you off to the closing bell here in the U.S. So let's get a check on where markets stand. Everybody knows it's been a bad day today, but what's interesting, Katie, you got VU, which is the S&P 500, down 1%. Not too bad. But TLT bonds down too. So, for 60-40 investors, that's a big bummer. Normally, the bonds are supposed to go up when your stocks go down, which is good for alts and buffer ETF issuers. They're loving life today. And gold is up. That's understandable. Gold's at all-time highs, been having a great year. And Bitcoin is up. I bid up 2.3%. That has got to be a welcome relief from the Bitcoiners who are really hoping that Bitcoin decouples from the equity markets. And today it is, and that will help bring the correlations down.
Yeah, if you're hedging with Bitcoin for whatever reason, you're in a good mood today. But all told, Wall Street kicking off September on a sour note, with the mega caps really dragging down those major averages. Nvidia seeing its longest drop since March. Bonds also sliding alongside equities, as Eric was walking us through, with the 30-year Treasury yield approaching 5%, pressuring tech shares, whose valuations have widened during an almost 5-month surge. But Morgan Stanley's Mike Wilson isn't letting one day sour his entire market outlook. Wilson says that the current...
Everybody's kind of focused on what's happened with the tech stocks. They've had this unbelievable run. Do they take a little bit of a breather, and do we see a rotation?
Now, Mike Wilson says that the current U.S. stock rally has further room to run, and it will continue to run higher as Federal Reserve interest rate cuts coincide with robust corporate earnings. Remember, Mike Wilson was the strategist who correctly predicted a rebound following April's sell-off, saying that the economy was heading into an early cycle backdrop. But one place we're seeing an uptick: M&A, breakups, IPOs, and activism. We're seeing big headlines in all those spaces today, whether it's Kraft Heinz separating into 2 publicly traded companies, Elliott taking a $4 billion stake in PepsiCo, Klarna announcing its IPO plans, or Air Lease being sold for $7.4 billion. We're going to touch on all of that and more later on in the show with Ethan Klingsberg. He is partner and co-head of U.S. Corporate and M&A over at Freshfield. A lot to get to today, Eric.
Yeah, there is. And, just to kick off our first guest who wants to talk about the Magnificent Seven, who doesn't? Look, the Magnificent Seven have just been absolute stars. They're like the dream team of stocks. Here's a look at the Mag 7 versus the S&P 500, of which it's in, for 10 years, right? That's 10x the return of the S&P. And if you look at the S&P's 250% return during that time, the Mag 7 makes up almost half. So that's 7 stocks contributing to half of the performance. And when you look at the weighting of the Mag 7, they're now about 33%. They're a third of the S&P. I personally have no problem with this. I think these are great stocks, and over time, only a few stocks tend to drive index returns, and these are those stocks. So, but we'll see what our first guest has to say about this.
I think he has a lot to say. Let's get to him now. His name is Michael Green. He is portfolio manager and chief strategist with Simplify Asset Management. And we'll start there right now, Mike. You're seeing sort of the downside of the fact that these Magnificent Seven stocks have gotten so big with this big drag that we're seeing on the S&P 500. What do you make of where we stand when it comes to big tech's influence right now?
Well, as you both know, I'm very much a believer that we are in an environment, largely because of the distortions that are created by passive investing, in which the largest stocks receive additional pressure upwards, contributing to the performance that we've seen in the Mag 7. With that said, over the last couple of months, we've actually started to see a compelling change in narrative where people are really starting to question the investments, and in particular, the large cash investments that these firms are being forced to make in order to stay current in an AI-driven spending boom. A lot of people talk about this in financial conditions and say that the Fed should raise rates because this is ultimately indications that the higher interest rates have not meaningfully or appreciably slowed the economy. The reality is these companies are engaged in equity-driven spending, in which their very low cost of capital has encouraged them to spend obscene amounts of money. And the real question now is, will there be a return? Or is this going to be very much like the telecom sector in the late 1990s, in which all the investments were made only to see telco revenues fall by 50% over the next 5 years?
Yeah, that is one of the existential questions here, whether we're overbuilding, whether we're over-investing. I want to go actually to the credit portfolio, the credit profile of some of these Magnificent Seven names. We talk about the equities all the time, of course, but you have sort of a counterintuitive take here, or at least one that isn't very popular among some of the folks that I follow, that you take a look at the credit quality of some of these Magnificent Seven giants, and you're finding some cause for concern.
Yeah, I think people should be very aware that the narrative of the very strong cash balances is increasingly giving way to these companies taking on significant quantities of debt. Obviously, we've highlighted components like Meta in particular, which has just been spending an obscene amount of money, and more interestingly, doesn't seem to have a lot to show for it. And beyond even just the absolute levels of debt that they've taken on, which has resulted in their net cash position deteriorating from nearly $70 billion in net cash just 2 or 3 years ago to today, they are actually at slightly positive net debt. So they actually have now borrowed money. Once you incorporate the operating leases for computing power that they've entered into with Google and others, this is a pretty amazing statement. When a company operating at Meta's scale needs to outsource its capital and obtain basically financing from a vendor like Google, that's really an extraordinary statement about the somewhat precarious position that many of these companies could find themselves in.
Yeah, but Mike, so I talked to our credit analyst in BI, and they said, look, Meta would have to go down about 50% for there to be any credit issues. And the other part of this is, don't you want these companies to be aggressive in something that has as big a potential as AI?
It becomes a question of, is AI net contributive, or is AI effectively just fighting creating a defensive line to try to preserve the existing profitability? When I look at a company like Meta, I see one that has 3 primary business units. Facebook, which is effectively a boomer graveyard at this point, very underutilized by younger generations. Instagram, which appears to be having its lunch eaten by TikTok. And WhatsApp, which is an incredibly compelling telecommunications platform, but there appears to be no mechanism for monetization. And so I'm forced to ask myself, what are they spending money on? And to your point about valuations retreating, if I look at these companies and I start saying, are they moving X growth? Is this money being spent to protect their existing franchises as compared to expand them? If I believe that's the case, they shouldn't be trading at the multiples that they're trading on. These are off of peak earnings that they're trading in the mid-20s or even higher valuations. That's an exceptionally high valuation for a company that is fighting a rearguard action.
Okay, so let's say you agree with this. You think Mag 7 overvalued. Something's got to give. What do you do in a trade? Do you rotate to an equal-weighted S&P? Do you go to cash? Given passive's influence in the market, and these Mag 7, or do you just stay there because the money's going to flow in anyway?
Well, I think this is one of the really interesting outputs that comes from this. If you look at the academic research that has been done on the point that I raised at the very beginning, the impact of passive investing causing these companies to rise, the same phenomenon begins to work in reverse. If these companies are falling, it's almost inevitably telling you that there's a broader economic condition that's out there that's causing this deterioration in flows. Now, the Mag 7 themselves are particularly susceptible to one area in particular, which is reduced corporate share buybacks. If we start to see warning signs there, then I would actually be much more supportive of the idea of rotating. On the interim basis, I know that I am very much outside consensus on this, but at the end of the day, I am drawn to things like TIPS and to bonds, which, as you point out, yes, the 30-year is pushing the 5% range, but the 2-year is right at the lowest level that it's been in the past couple of years. Those two cannot actually be resolved unless you think that unless you think somehow or another that inflation is going to rapidly accelerate under the conditions that we just described, which sound distinctly deflationary, not inflationary. You end up with a position in which you say, wow, the opportunity in bonds is actually pretty compelling once we look past the current concerns.
Well, let's talk about that a little bit more, because, I mean, you just focus in on today's action. As Eric said, you have equities down in a big way, and then you have bonds also, at least when it comes to the longer end of the curve, not behaving as that portfolio hedge that you might reach for in a moment like this one. So, Mike, when you say that there's an opportunity in bonds, describe that a little bit more.
Well, what I would emphasize is that that protection that you're describing in the bond portfolio has really not been true for several years now. And a big chunk of that, again, I would argue is a function of what has happened with the Fed. The Fed very aggressively raised interest rates. Perversely, what that does is change the construction of bond indices, which, just like equities a decade ago, have become the dominant investment vehicles by which people invest in bonds. And so if you're buying a total bond market index right now, as most Americans would be through their target date fund or their retirement funds, those indices now are distinctly underweight that duration component. And so this is a question very much of neglect that I would argue is not dissimilar to the concerns that people have had about small caps or about emerging markets. Ultimately, the opportunity remains there. It's just a question of how quickly will it be realized. And in the interim, you're earning a pretty nice return at 5%, or in tips, potentially even more under these current conditions.
And Mike, I gotta talk passive with you. So I got a chart that my colleague James Seyfert made. It shows that 20% of the S&P is now owned by index funds. And if you add an institutional, you might get to like 30, 35%. This appears to be expanding, but active's having a comeback. How does this change? Do you think it needs regulation, or can active actually move the pendulum and the market handle this?
Well, I think that there's two separate components there. One, again, we need to expand well beyond the index funds. We need to include things like CITs, separately managed accounts, et cetera. So my math, and James would actually broadly agree with this, is that passive is now more than 50% of the assets by market cap weight. The second thing that I guess I would emphasize is that this is largely a function of the thumb being put on the scale by government. Passive investing is granted beneficial treatment under liability management, et cetera. It is encouraged to be included as things like the qualified default investment alternative in 401ks, which more and more people are defaulting into and not changing. And so the argument that I would make is very straightforward. I just want the government to lift its thumb off the scale and to effectively say, you know what, investing is really hard. People are going to have to make choices. But ultimately, the market is not about retirement. The market is about allocating capital. And I understand that that's a frustrating message. I understand that that doesn't appeal to people who do think that the market is about retirement expenditures, et cetera, saving for retirement. That is one of the benefits of a well-functioning market. We no longer have that well-functioning market.
All right, Mike, great to get some time with you kicking off the show. That is Michael Green. He is portfolio manager and chief strategist with Simplify Asset Management. Meanwhile, let's take a look at shares of Apple taking a leg lower with breaking news now that the company's top AI robotics researcher is out, heading to Meta of all places. Let's bring in Bloomberg's Mark Gurman for more on this. He broke the news here. So the exodus of AI talent from Apple continues.
Yeah, it's quite something. Over the past couple months, since the beginning of July, Apple's large language models team and AI engineering teams, particularly on the research time, has been bleeding talent. To this point, in just 2 months or so, they've lost roughly a dozen AI researchers. The latest exit goes to Meta. This person was in charge of AI-related research for robotics purposes within its AI division. 3 other people have left in the last week or so. One, John Peebles, is going to OpenAI. Another is going to OpenAI, and a third person is going to Anthropic. So the first set of departures of the past couple months, most of them went to Meta, following their boss, who left Apple for a $200 million plus payday at Meta.
Not bad.
These ones, not bad, going to Meta, Anthropic, and OpenAI as well.
So are these departures just about the money, or is it a culture issue also?
There's a few things going on here. So one, the money. The pay packages at Apple pale in comparison for these top-notch academics and AI researchers compared to what you're seeing in some cases at OpenAI and Anthropic, but the pay packages at Meta are just ridiculous. The other thing to note is that Apple has been seriously contemplating moving away from in-house model technology for some of its products and using more from companies like Google or Anthropic or OpenAI. And the LLM researchers at Apple, some of them think they're seeing the writing on the wall, and maybe it's time to get out of there before Apple really reduces the use of their technologies. Of course, internally, Apple has denied the idea that they're going to move away, but there is going to be some parts of Siri next year moving away to a third-party provider. So they're seeing it happen, and they don't want to be, in their minds, the last ones to flick off the lights on the way out.
Well said. Thank you, Mark Gurman from Bloomberg News. Upheaval in the consumer space today with Kraft Heinz bracing for a breakup and an activist investor descending on PepsiCo. The stock's moving in opposite directions. Kraft Heinz sharply lower, with Warren Buffett saying he's disappointed about the split, and PepsiCo ticking higher on optimism around Elliott Management's fresh $4 billion stake. Let's bring in Crystal C for context. Crystal, great story. What's going on here? Why is Kraft being so sold off versus Pepsi?
So it's a story of breakup versus bulk up. We have seen for almost a decade that a lot of the consumer companies were like bulking up into a conglomerate, and we kind of now seen like the end of that cycle where they're doing the opposite. They're like becoming more like focused in what they do, more simplifying their portfolio. So the story about Kraft really was well televised, that they already announced a strategic review earlier this year, and now they have decided to split the company into two, essentially condiments versus everything else. And then the Pepsi story with Elliott is a very classic Elliott playbook. Boost your value, and we'll see what they do.
Yeah, and you can see that anticipation in the shares right now. I want to talk a little bit more about Kraft Heinz, the breakup part of bulk up or breakup, because it's interesting. You heard Warren Buffett expressing regret that they're separating. His view is that this isn't going to solve some of the problems that Kraft Heinz is facing right now.
So Kraft Heinz actually has gone through so many transactions before it became the current form of Kraft Heinz. And if you remember, like, it was a big merger in 2015, and before that there was like the 3G involvement from Brazil. So a lot had happened, and a lot of the consumer retail problem comes from very systemic health concerns. Americans, or just like globally, people are just eating healthier, and with the impact of GLP-1, there are some very fundamental basically trends that they cannot overcome as a company on its own. Buffett told one of our rivals that basically he's not happy, he's a little bit disappointed, and he's also complaining a little bit about his frustration that shareholders will not get to vote on this deal.
Right.
So we'll see how that comes through.
In the case of Pepsi, is it about getting more healthy drinks, changing the product line, or just like cutting costs and like gutting it to save money?
So lucky us, we actually get to see what Elliott wants this time. They're saying that simplify your portfolio, that's number one. There's also like more about like refranchising with their bottling businesses and investing in growth. And growth is most likely what you're describing, the healthier for you soda. Yes, there are options in the market now, the Olipop, the Poppy. One of them have already traded, like whether Pepsi would now be forced to look at this other deal, that would be interesting. But healthier for you is generally the trend for all food and beverage companies.
And just broadening out a little bit, why are we talking so much about food and beverage companies in particular? Kraft Heinz, PepsiCo today. Last week it was Keurig Dr. Pepper with JDE Peet's. It just feels like this industry in particular is going through a moment.
It had been a bit of a sleepy sector for like the better part of the past 5 years. There were a lot of strategic review, there were a lot of portfolio review that didn't go anywhere. Every one of these companies at some point had looked at selling some tail brands, like the less performing brands. That didn't quite work out. But once they saw that Kellogg did that very successful breakup and eventually sold off both pieces, I guess that sort of inspired like some of these companies to like look at whether that really unlocks value. And that also attracted activists to kind of deploy that same thesis.
All right, it's going to be fun to see who is next. Bloomberg's Crystal C with the great reporting on the M&A landscape, as always. Now, coming up, Zscaler earnings set to release earnings in less than an hour. We'll preview what's to come in that report with an analyst who covers the stock up next. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we start with Frontier. Deutsche Bank's call is taking flight, with the firm upgrading their recommendation to a first-class buy rating, up from a hold, and a price target of $8. The analyst says that the low-cost carrier is best positioned to benefit from rival Spirit's bankruptcy. Shares up 14%. Up next, we have Elf Beauty. Deutsche Bank downgrading the cosmetics company to hold from buy, but raising its price target to $128 from $121. The firm is taking off its rose-tinted glasses, saying that there's, quote, no clear upside potential in the near term, with valuations seeming sky high, shares pretty much unchanged. And finally, we have Zscaler, Morgan Stanley scaling up its rating to overweight from equal weight and boosting its price target to $320 from $280. The analyst believes that Zscaler could cement itself as the next true platform, along with Palo Alto and CrowdStrike. Shares down a little bit in anticipation. Those are some of your top calls. Zscaler set to report results after the bell today, and here to help preview it is Peter Levine. He is an equity analyst over at EverCore. And you think about where we stand in the course of this year with Zscaler, shares up about 50% year to date on a total return basis. Peter, I have to imagine that the bar is pretty high.
You know, it's I will say Zscaler did underperform last year, but you know, Zscaler from a cyber perspective has definitely outperformed the group. And you know, if you're looking year to date, they put up a really good quarter. This is their fiscal 4Q, so there is a lot of I wouldn't say anxiety, but there's definitely a lot riding on this quarter. There's a new CFO who's going to give the full year guide for the first time. So there is that dynamic. And then from a macro perspective, I think what's working for them is we've heard from Palo, CrowdStrike, macro has not been a concern. I think earlier in the year it was. We've heard this quarter it wasn't. So for Zscaler, I'm not expecting any macro concerns in the quarter, nor expecting them to kind of implement any macro kind of hesitation into their guide.
Let's talk about some of the competition here. I mean, we just read about that note from Morgan Stanley saying that Zscaler could rank itself among the likes of Palo Alto and CrowdStrike. How have earnings gone for some of their peers that at least Morgan Stanley thinks that they could stand along beside?
Yeah, they've done an incredible job, I think, broadening out their platform. The recent acquisition of Red Canary, I'm sure we'll hear a lot more about. I think the application of what they plan on doing with Red Canary, but as an example, that's going to help them on their AI application, meaning they're going to have an automated SOC tool. So I think over the past 12 to 18 months, they've done a really good job of broadening out their platform. You do see the consolidation trade within network security, so that does play with them. And then with Zscaler, from a competitive perspective, they still own the enterprise. There's a lot of competition down market, but for Zscaler, they do still own the enterprise market.
So overall, I'm ETF analyst. I remember when Hack was launched, right after the North Korea hack, and cybersecurity went wild. It like outperformed everything. But in the past 3 years, it's only up 28% as a group. And internet and tech is up 100%. I just would think everybody would want cybersecurity. How come the returns aren't better?
I think cyber, there's been a lot of idiosyncratic, I think, factors impacting a lot of these individual stocks. But from a demand perspective, from our work, I don't think that's gone unabated. So you still have the geopolitical risk, the threat landscape, domestically, internationally, cyber attacks are not going down; they're only going up. So I think the secular themes, I think makes cyber less vulnerable to discretionary spending cuts versus some other subsectors of software. But broadly speaking, I think the underperformance. I think there's been a lot of there's been a lot of money flow into security. Perhaps maybe expectations got ahead of themselves. But from a demand perspective, cyber still remains, I think, from our perspective, one of the safest areas to invest, just given all of the secular trends that I think aren't as present in other sectors.
And given Zscaler's return, which is way better than the index, it seems like active could pay off here.
No, it can. I mean, Zscaler's been an incredible stock this year. Again, I think lack of performance last year, they've corrected a lot of their issues. You're seeing a lot more momentum up market. They're broadening out their AI suite. They've made, some strategic acquisitions over the past year. So a lot of it seems to now be coming into play. And again, this quarter would be a big quarter to kind of see what, the next year brings. And I think there's definitely a lot of anticipation in terms of, the new CFO just setting, I think, communicating correctly, and I think properly to investors, given that this is his first time giving a full year guide. But just given the backdrop, the demand perspective, I think Zscaler's product, again, from a long term perspective, it's been a great stock, and I believe it will continue to be a great stock.
All right, looking forward to seeing those results after the bell today. Of course, we'll bring you them as soon as we have them. Our thanks to Peter Levine. He is an equity analyst over at EverCore. Meanwhile, you take a look at markets right now. A big drawdown on the first day of September for the equity market after a month that saw really good gains when it comes to the equity market and a slew of M&A deals. But can we expect more of the same for the rest of the year? We'll ask Ethan Klingsberg. He is partner and co-head of U.S. Corporate and M&A at Freshfields. It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm Eric Balchunas.
And we are following President Trump saying moments ago that he will appeal a federal court's ruling rendering his tariff policies illegal. He also says that the stock market wants and needs tariffs as he answers reporter questions in the Oval Office. Wants and needs tariffs. Certainly the stock market wants something today because, boy, what an ugly start to September.
I've always thought there's this conflicting wants with him. He loves the stock market up, but he also likes tariffs. And those two things don't gel very well.
Yeah.
Although the market's held up pretty well, I think better than people thought. But certainly those are, I think, conflicting wants for now.
Absolutely. I mean, you can't complain too much when we're this close to all-time highs, but it certainly feels like, at least when it comes to the tech sector, there's some reevaluation going on when it comes to valuations and, of course, just where we stand in the trajectory of this year.
Absolutely. So tariffs will affect everything in the markets, including the M&A market. Joining us now is Ethan Klingsberg, partner and co-head of U.S. Corporate and M&A at Freshfields. So, Ethan, you're in a great position because M&A is one of those things that I was told was going to be over because of the tariffs. But you say it's picking up. You have direct access to the boardrooms. What's going on?
Yeah, it's interesting that you point out the conflict because we have competing forces which are actually creating a great chemistry for what I think is going to, well, it was a great August, and I think we're going to, what I'm seeing is a great fourth quarter. The reason is there's lots of forces driving up and lots of projections for the next 3 years because of data centers being built out, energy being built out, a lot of companies reimagining themselves. But at the same time, there's a lot of fear that after these next 3 years, maybe 5 years, there's going to be a flattening or decrease. After these build-outs are done, after the reimagining for AI is done, then all of a sudden you have a flattening. Also, there's concern that there's going to be winners and losers. So when you have that anxiety at the same time as good news, you say, maybe now's a good time to sell at a premium, or maybe now I should use my stock and be a consolidator because I still have a compelling case that I could be a winner.
Is a lot of this M&A going to be private companies being bought or like micro caps? Or are we going to see any like blockbuster big ones that sort of catch everybody's attention?
I think we're going to see some of both, right? Because on the one hand, if you have a company that's reimagining itself, let's say in the tech sector, and they're concerned, we don't know how it's going to turn out over the long term, consolidating is a very safe play, and a lot of their stocks are doing very well. At the same time, we have a lot of companies in spaces like consumer brands, retail, that may be seeing lots of turbulent times to come because of tariffs, inflation, maybe long-term interest rates are going to go up with increased borrowing. So, but they're still well run, they have steady revenues, so they're perfect for the private equity playbook to take private. So I think we could start seeing more of those. Similarly in software, there's a lot of concern. A lot of companies are thinking, well, maybe AI is going to take the secret sauce away from some of the software service companies. So again, they could be taken private by private equity. And remember, private equity now, the playbook is not necessarily that in 5 years they have to turn these portfolio companies into big, sexy IPOs. What they can do is, they can sell them to strategics, like we just did a very nice deal for Lowe's buying out of private equity, but they could also just keep selling them over and over in these continuation funds. So I think a lot of these companies are going to play very nicely into the private space for that reason.
Well, it's a really interesting point that you make, that it's not necessarily, like you said, 5 years until the IPO, that traditional playbook. But when it comes to just the overall M&A landscape, yes, we had a really big August, the best August since 2021 or so. But it feels like we've been here before. How can you be confident that this isn't just a burst of optimism, that, you know, maybe some of these other headwinds that we keep talking about, the potential of a downturn perhaps, won't come in and sort of crush this enthusiasm?
Oh, the downturn's coming. But I think we still have some runway before we get there, and that's going to push because it's the anxiety over what comes next that's going to push folks. If you look, for instance, at the presentation Elliott put out today about Pepsi, they're saying do some divestitures, do some acquisitions. There's also concern that interest rates are going to go up for certain borrowers. A lot of heavily leveraged companies out there, like EchoStar just sold so that they could pay down debt. CommScope just sold some carve out, they can pay down debt. So there's lots of reasons to engage in the M&A now. Plus, the antitrust situation, although still difficult, last time I was on, I was describing how the progressives and the populists come in a similar approach on antitrust. Nonetheless, there is a lot of deal making going on by the Trump administration antitrust agencies. And when you have deal making going on, meaning you can agree to remedies, putting aside whether or not they actually address the policy issue, but you can get through by reaching an agreement on remedies, that gives optimism that that's not going to be a headwind anymore, which it really was during the Biden administration.
Well, you mentioned the government in the context of deal making, and my mind goes straight to Intel. The government taking a 10% stake in Intel. It's not totally unprecedented, but there's definitely some nuances to this specific case and this specific instance with Intel. But I'm wondering if you see more of that coming, the fact that you could see the government just directly coming in and taking stakes in U.S. companies.
Yeah, this is another situation, right, where we have the populist and the progressive. I mean, it's almost like Secretary Lutnick was quoting Bernie Sanders when he was justifying the Intel investment. It puts boards in a really difficult situation because remember, there's no exemption from fiduciary duties just because you're doing a deal with the U.S. government. There's no immunity from shareholder suits just because you're doing a deal with the U.S. government. And there is a takings clause in the Constitution that says you have to get just compensation, and companies will want to enforce that right to just compensation for what they give. So yes, there may be more of these, and there's certainly illusions. I'm not going to read the political landscape, but I can tell you from the boardroom perspective, there's a lot of consternation because there's a lot of thoughtfulness about valuation. What kind of governance rights are we giving away? What other assets of the company and the shareholders are we giving away when we're entering into these arrangements where the government becomes an equity holder?
Yeah, it's fascinating. I want to go back real quick to the antitrust issue because Mag 7's a theme today, I think, Katie.
Yeah.
I looked at the Magnificent Seven. They have acquired 850 companies between them. Google is like 250. Microsoft is 250. I was floored. GE back in the day, which was massive, was only like 80, only 80. But how are they not antitrust issues? How are they not already broken up, given how big they're getting? I made this case because I think there are really 70 companies in the seven. I mean, are we going to see them broken up?
Well, and we have in the United States an incredible ecosystem, right, where we're taking these VC-backed, founder-led companies, nurturing them over time, and the exit is not through the IPO. I mean, it's just not there. So if you didn't have the ability of some of these cash-rich tech companies to keep recycling and buying out the equity, it really would hurt this whole farm system that we have that has worked really nicely in the United States.
It is fascinating. I'm glad that we are ending on this point because, you know, breakups are very popular right now. Spin-offs are very popular. But then you have the true conglomerates, and those are the tech companies. Ethan, have to have you back soon. Really enjoyed this conversation. That is Ethan Klingsberg. He is partner and co-head of U.S. Corporate and M&A over at Freshfields. Now, coming up, the stars not exactly aligning for Constellation Brands, one of the biggest drags on the S&P 500 today after earnings. It's today's Stock of the Hour, up next. This is The Close on Bloomberg. Today's Stock of the Hour is Constellation Brands. Shares sinking to lows not seen since 2020 after the alcohol maker cut its guidance for fiscal year 2026, citing weakening consumer demand. It's one of the biggest drags on the S&P 500 today. So for more, let's turn to Kenneth Shea. He is senior analyst of beverages, tobacco, and cannabis over at Bloomberg Intelligence. So all the fun stuff there. But Ken, I understand that they cut guidance. Then you take a look at where we're set to close at the lowest level since April 8th, 2020. Is it really that bad?
Yeah, hi, Katie. I think the reaction today has been so negative because of the success that Constellation's beer business has had over the many years. I mean, this is a very predictable, high single-digit sales grower, you know, and a lot of it was based on good volume growth, high pricing flexibility, particularly led by its Corona and Modelo brands. And fast forward to the past 6 months or so, and has slowed dramatically. They have lowered guidance for the last couple quarters. Last quarter, last results, they said the business was poised to grow at a low single-digit rate. Today they came out and said it's going to decline at a low single-digit rate. So it's really the sudden change in direction. And I think what the market's trying to grapple with is this a near-term thing or is it a longer-term thing? The company is pointing to, you know, weak consumer spending. Okay, that's understandable considering that Corona and Modelo trade at high price points. These are premium price products relative to popular price beers. And they point to the fact that the Hispanic market has been particularly weak. They're over-indexed to that demographic. Fair enough. But I think what goes lesser said is that perhaps the cutback in alcohol consumption by Americans in general is also weighing on this. I think the market is trying to digest. Maybe this has a longer-term slowing issue, and not just a near-term one.
Ken, yeah, look, with alcohol, I sense that there's people who are really trying to trash alcohol. Like, I see it a lot. You don't sleep as well. It's like not good for your health. It seems like a lifestyle issue maybe and a long-term negative trend. We just talked to the reporter covering Pepsi about healthier options. Do they need to like reinvent the wheel here and serve this stuff in a much more low-cal, interesting way?
Well, yes, a good question, Eric. What are they doing about it? What are they doing? Well, the low alcohol, no alcohol versions are gaining popularity, and Constellation, to their credit, is doing that. That's a growth market. Perhaps packaging sizes could be one. But also the ready-to-drink market is doing pretty well. Consumers that do like alcohol tend to like the new, interesting flavors, the portability, things like that. And Constellation, to their credit, again, is playing into that. The only thing is, though, beer accounts for about 85% of this company's sales. So it's a battleship. It's not going to turn tomorrow with these growthier areas within alcoholic beverage or non-alcoholic beverage, for that matter, that it's going to make a material difference. There's not a lot they can do about it, quite frankly, right now, except maybe just try to hit new markets. But other than that, they're really banking on the beer industry to be revived.
Yeah, we'll see how that shakes out, but certainly an ugly day for Constellation Brands. Great to get some perspective there from Kenneth Shea. He is Senior Analyst of Beverages, Tobacco, and Cannabis at Bloomberg Intelligence. Now, coming up, we are just about 15 minutes away from those closing bells on a very ugly start to September. We'll take you through all of the action coming up next with Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. This is The Close on Bloomberg.
I'm very much a believer that we are in an environment, largely because of the distortions that are created by passive investing, in which the largest stocks receive additional pressure upwards, contributing to the performance that we've seen in the Mag 7. With that said, over the last couple of months, we've actually started to see a compelling change in narrative where people are really starting to question the investments.
That was Michael Green, Portfolio Manager and Chief Strategist with Simplify, kicking off the show. Welcome back to The Close. I'm Katie Greifeld alongside Eric Balchunas. And Eric, we have a sell-off on our hands.
We do. This is like a back to reality kind of day, so it feels right that there's a sell-off. Let's check again the same ETFs we went over earlier. A little good news here. Looks like there's been a little bit of buying back because the VU was down about 1% earlier. This felt like a garden variety dip, and one reason I say that is because I like to look at SPY volume as a fear indicator. It's only 38 billion. I don't look to 60 billion is a unofficial.
That's a real sell-off.
We officially call it the freakout zone. So we're well under 60 billion. So it feels like a tweak, not a wholesale sell-off. But gold up that much is a little worrying. So we'll see. But these numbers got a little better.
Yeah, and it's interesting to see Bitcoin rallying right now, up about 2.4%. Let's bring it all together now with Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. And Jason, you can't make too much out of a single day, but let's talk about what is underway right now. Has something fundamentally changed when it comes to what we're seeing in tech, what we're seeing at the S&P 500, or is this just a flipping of the calendar?
I think it could be a combination of the two things, just to kind of set the stage here. In terms of this kind of back to reality, and maybe a little bit more of a back to school sort of moment here. We all know that kids are getting back to school. The market's basically coming back from what has been a kind of a lower volume period of the calendar, August through the beginning of September. We now see investors re-engaging. We're still on a little bit of a light volume day, as you already mentioned earlier on the show. So you can't take too much forward with it. But at the same time, one of the things that happened last week is we had the last report of the earnings season from NVIDIA, and it put a little bit of cold water, good report, but a little bit of cold water on the prospects for growth, which I think set a little bit of a different tone in the beginning of this calendar month, as valuations for a lot of technology issues are still sitting at fairly high levels.
And how much of what we're seeing is being driven by some of the things you mentioned? Of course, the corporate picture with earnings. We have economic data hot and heavy this week. We also have a lot of cross currents coming out of Washington. We just heard from the president talking about, of course, that ruling overturning his tariffs. The president saying this market wants and needs tariffs. Jason, I wonder how much stock you put in that.
So let's hit those one at a time. First and foremost this is going to be an important week from an economic perspective because of the employment report and the implications for the Fed. Investors are going to be very focused on that. Secondarily, there was this tariff issue, which we actually think the markets don't necessarily want or need, but they have already dialed in expectations for what tariffs should ultimately end up at. Somewhere in the ballpark of about 13% effective tariff rates is what we think the market is basically dialing in. And this does not necessarily disrupt that. They already know that the administration has 2 or 3 more options to implement the same tariff programs, maybe a little bit more work on the administration's part to get those through, but would necessarily or effectively have the same effects in terms of the magnitude of the tariffs impacting the economy. So we think markets are probably looking through that court ruling, even though the administration may have a lot of work to do as a result of it.
And how important is the Fed here? Because it seems like almost like a win-win, right? If the economy's great and jobs are, unemployment goes down, everybody's happy. But then if it's not, you got these cuts coming up probably. And it seems like the market is really banking on at least one cut, maybe a couple down the road. And then next year and the year after, if there's a real push on the Fed to keep cutting, it just seems like, why would you sell?
Yeah, generally, we are actually in a fairly good position at this point in time. Tariffs might be a headwind, but fiscal policy is a nice tailwind as we turn next year. And the Federal Reserve will probably provide a little extra tailwind because when you really look into the data, labor markets, while not out of balance and showing a big spike in unemployment, are slow in growth nature, which gives reasoning for the Federal Reserve to put in place a couple more, maybe insurance-like cuts for the job market, and therefore support the overall economy and the market at the same time as we head into the back of the year.
So retail investors have done nothing but buy stocks all year. They're unperturbed by anything bearish. I feel like they need to see something in their personal lives that has economic pain, or their community, or just the total massacre in earnings. Do you think one of those two things will happen?
I think that's actually a pretty far stretch to have one of those two things happen. And I think I would agree with your thought process in that once markets reach elevated levels, as long as they're not at like nosebleed territory, which we don't think we're quite there yet, maybe some tech issues are up there, but generally overall, the market is not. Without being in nosebleed territory, they can remain overvalued so long as the general backdrop for the investors themselves and the economy itself remain in reasonably good shape. And we think that's probably what we have heading in at least into the beginning of next year.
And Jason, I want to go cross-asset here. You are the Chief of Investment Strategy and Research, so you have that view. And as we keep pointing out, you take a look at today, you have stocks down, you have bonds down. And this is kind of an existential question. Happy Tuesday, that bonds have been dealing with is whether or not they actually are a hedge in this market. Are bonds still the haven trade here, or do you go to something like gold, which is having a good day?
So, Katie, I think we think you have a couple of approaches here. Number one, bonds, because of the higher yield now, they do provide a better position for balancing out the portfolio. Generally, they act as a ballast in portfolios, but they don't always do, particularly when the market's trying to decipher exactly where interest rates are going. Broadly speaking, we think there's a lot of things investors can do. You shouldn't just own large cap stocks. You should own a broader basket of stocks, including small cap stocks, international stocks. And in today's market, those are providing a little bit better of hedges than they were in the past. And then for some investors, if you're comfortable with owning something like gold, gold is a reasonable thing to do for a small portion of your portfolio to hedge out the portfolio. I would argue that gold at this point in time has gotten to be relatively pricey and probably is due for its own pullback, similar to what we're experiencing in the equity market today.
All right, Jason, great to get some time with you. That is Jason Pride. He is Chief of Investment Strategy and Research over at Glenmede. Of course, we welcome in September with a pretty ugly start to the month. As Eric was telling us, it feels like 2022, that kind of a day with stocks and bonds down in concert. We are moving closer to the closing bell now. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Eric Balchunas, and here to help take us through the closing bell, we're joined by a global simulcast, Carol Masser and Tim Stanovic. Carol back from vacation, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide. And what a trading day we are putting behind us. The S&P 500, we're not going to close quite at session lows, Carol, but still an ugly start to this month.
Yeah, kind of rough, right? And we are, there's just kind of a lot coming at investors this month. We know we've got the jobs report on Friday. We have a lot of economic news, a Fed meeting in a couple of weeks. But I've been looking at the SOX, the Philadelphia Semiconductor Exchange Index, and it is down about 1.2%. This news that the U.S. has pulled TSMC's waiver for China shipments of chip supplies. So basically, revoking TSM's authorization to freely ship essential gear to its main Chinese chip-making base. So, yeah, I feel like the semiconductor area under some pressure here, Tim.
Okay, so maybe stocks under pressure, maybe it's a risk-off day when it comes to the bond market. Interestingly enough, that's kind of being ignored when it comes to at least some cryptocurrencies. Bitcoin up 1.7% as we speak. Ether was up much of the day, just about $400 off of that all-time high reached last week. So not moving in unison, not moving in tandem today.
Yeah, I mean, that's a good sign. If you're in crypto, you want that lack of correlation. That's how you attract the big fish, because they don't want a tech stock. They want digital gold. So good sign for Bitcoin. I'm looking at ARK. ARK has been leading the way. Getting hit hard today, but still up like 33% this year. To me, that's always like the canary in the coal mine for a growth sell-off.
Right.
So we'll see what happens with that.
And we can hear the bells ringing right now. And here are our closing levels. The S&P 500, 64.14 or so. We're going to finish down about 0.7%. It feels like just last week, and it was, that we were just above 6,500 on the S&P 500, Carol. We're still very close to those levels, but certainly a risk-off day.
All right, certainly risk-off with a lot coming out of investors, as we mentioned earlier. Hey, if you look at the S&P 500, folks, dig a little deeper, and you've got most names in the index lower today, 385 names to the downside. Eric, 116 gaining ground.
Yeah, looking at the sectors, it's bad. It's pretty bad today, but, it's just the day. And the top sector is energy. As Katie said earlier, it's deja vu 2022. So that's not good. Also, you had stocks and bonds down. So it's almost like the whole year has been like 2024 redone. And yet today seems like 2022. So we'll see what tomorrow brings.
All right, let's get to some of the individual gainers. That's a lot of red on that screen, but there are definitely some outperformers in a big way. So let's get to it. PepsiCo at its highs today, folks, up more than 6%, finishing the day with a gain of about 1%. A top gainer in the NASDAQ 100 at 1 point. Shares rising after Elliott Investment Management confirmed it took a $4 billion stake in the company, making it one of the largest investors in PepsiCo. Elliott outlining its plans for the company, including potentially restructuring its beverage unit, reviewing its snack offerings. Company has really struggled in the face of competitive pressures and really changing consumer I guess, taste, if you will. So we'll see. We're keeping an eye on that, but investors are hopeful about some of the changes to come. Want to get to a name that was actually among the biggest gainers on both the NASDAQ 100 and the S&P 500. We're talking about Biogen. Ticker is BIIB, stock up 5.6% in today's session, and this had to do with the drug maker winning FDA approval for its self-injected form of its Alzheimer's therapy, and analysts see that approval aiding the launch of the drug by improving convenience for patients. So that was definitely some outperformance there. And then Frontier Group up 23% at its highs intraday, finishing with a gain of about 14%. Deutsche Bank coming out, raising the recommendation on the company to buy from hold, saying the firm is best positioned to benefit from rival Spirit's bankruptcy. You might remember last week, Bloomberg out reporting on how Spirit had engaged Frontier in high-level talks about the carrier's ongoing efforts to chart a path forward less than 6 months after emerging from bankruptcy. So Frontier definitely, Tim, an outperformer in today's session.
Okay, well, let's look at some underperformance today. I want to start with NVIDIA. Down about 6% over the last 4 days, down 2% today. The company's earnings showed restrictions on sales to China eating into revenue and uncertainty about when those sales could resume. That was to the tune of about $4 billion. Now, despite the recent drop, the stock is still up about 80% off that April low. Analysts see upside of more than 25% from current levels, with growth trends keeping valuation in check. We should note the whole chip sector under pressure today. Reminder, we learned early today that regarding TSMC, the U.S. has revoked TSMC's authorization to freely ship essential gear to its main Chinese chip-making base, potentially curtailing its production capabilities. Also, Kraft Heinz, speaking of like what's old is new again, the company plans to split into two separate companies, one selling Heinz ketchup, the other iconic condiments, and the other including slower growing grocery products. So the Oscar Mayer hot dogs go in one, and ketchup and other iconic condiments go in the other. The goal of the split is to give the company's top performing sauces and spreads more room to run while siphoning off lagging grocery staples in a new entity expected to generate reliable cash flow. Shares today down by about 7%. And finally, Constellation Brands falling 6.6% today. This after the company cut its fiscal year 2026 guidance and cited weak consumer demand, which will hurt inventory rebalancing at this distributor level. I guess, Katie, people aren't drinking like they used to.
Yeah, we were just speaking about that with Ken Shea. Used to be just Gen Z that was turning off from booze, but it seems like it's broader than that. Anyway, let's get to the good stuff and talk about bonds, because we saw a sell-off in the bond market. No haven bid there, and you can see it was a curve steepening move. You had 2-year yields rising, yes, a little bit more of a sell-off though when it comes to the long end. 10-year yields up 4 basis points, something similar when it comes to 30-year yields as well. So interesting movement in bonds day, taken in concert with stocks, Eric.
Yeah, and look, also we're looking at value and small caps. There really wasn't a rotation, both down 50 basis points. Value, both those can really just never catch a break. Even when large sells off, they can't get a bid. It's tough over there, and that's interesting to me. That makes me think this was just like a wake up, summer's over, I'm not in a good mood kind of sell-off.
I know that feeling. All right, folks, we do have Zscaler just crossing the Bloomberg terminal. Let's get to their numbers. Let's get to the outlook first. Second quarter adjusted EPS looks like they are expecting, fourth quarter, jumping around here. Fourth quarter revenue, $719.2 million. That is a beat, everyone. The street estimate was $707.9 million. Fourth quarter adjusted EPS, that too was a beat, 89 cents a share, Tim. That is 8 cents better than what the street was expecting. And they also talked about the first quarter outlook. Yeah,
shares up 8.5% in the after hours. Once again, fourth quarter revenue coming in at $719.2 million. The estimate will be for $707.9 million. Fourth quarter adjusted EPS coming in at 89 cents. The estimate was for 81 cents. First quarter revenue, that outlook that Carol mentioned, higher than the estimate of $752 million. Once again, shares higher, surging in the after hours by 9.2%.
Yeah, that's what happens, right? When you kick
when
up
you eat
the,
your protein,
outlook.
right? Is that what happens?
Well, let's go. There's a bunch of stories from Starbucks that we want to touch in. I'm going to let you do the protein one.
Okay.
I want to talk about Brian Niccol. He actually came out today, and he said that the fall product launch, which includes the return of the seasonal pumpkin spiked latte, drove a
Pumpkin
surge.
spiked latte?
Yeah.
Spice.
Spice. Oh, how did I?
What are you drinking? I want to know what you're drinking.
PSL.
I will say I had a lot of cocktails on my vacation. Seasonal pumpkin spice latte drove a surge in sales. He put out a memo apparently, and he said the product lineup helps to deliver a record-breaking sales week across their U.S. company-operated stores as well as strong sales in Canada. I am not a fan.
No, but the success of the pumpkin spiced latte notwithstanding, we know that Brian Niccol has been hired about a year ago to turn around Starbucks. And one thing that he's done is revamped menu items. And we learned also that the company's going to launch protein boosted lattes in cold foam in the US and Canada on September 29th. This is part of its menu modernization strategy. Protein lattes?
So hot right now, protein. I am excited for this. I have to say, the protein boosted cold foam lattes. I can't imagine it's a meaningful amount of protein. I'm excited to take a look at those macros. But also in the news when it comes to protein, there was a great story from Red Brown today about just how hot creatine sales are right now, particularly when it comes to women and older Americans. Apparently at GNC, sales of creatine have surged 75% versus 2020. So that really tells you something. I have to say, in my personal life, for some reason, my family, and my friends all got turned on to protein at the same time, saying we need to have more of it. So I don't know what's in the water or what's
What about
in the
creatine?
algorithm. Not specifically creatine, and Red Brown's story goes into this. I feel like creatine has some reputational damage still from its association with steroids, but apparently it's not stopping American women and older citizens.
Not much can stop American women. Can I just put that out there?
No, and certainly not steroid allegations. Anyway, I thought that was interesting, especially, I mean, Starbucks clearly jumping on that trend.
Yeah, I mean, I think creatine really, for what I've heard, is to bulk up. And so I like to lift weights. I use Weight Watchers, but I just have never tried creatine. I ran a poll on Twitter, and half of the people that follow me use creatine, which I thought was shocking.
And Eric has a gazillion followers.
And, I got a lot of people from the crypto world.
I was going to say, Eric, you're pretty big in the crypto world. So.
Yeah, you have to crypto adjust that number.
Yeah,
so maybe
exactly.
It's like 30%. But either way, a lot of creatine users out there.
Do one on seed oils next, Eric, and see,
Oh my gosh.
see what your followers are doing with seed oils.
I think you could do a show, Crypto and Creatine.
Yeah, yeah.
The Venn diagram, there's a lot of overlap there.
That podcast, that would be a great podcast.
All right, and if Brian Niccol's listening, we'll see if creatine makes its way into a spiked latte or something like that.
Delicious.
Yeah, exactly. All right, guys, that's a wrap. Our cross-platform. Fun to talk with you guys. That, of course, is Katie and Eric. They're going to continue there on the TV side, and Tim and I are going to continue right here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
Now, coming up, with the first day of trade in September underway, we'll take a closer look at the month ahead with Ryan Detrick. He is Chief Market Strategist at the Carson Group. Coming up next, this is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Eric Balchunas. Let's take a sorry.
Where are we, Eric?
Yeah, it's Tuesday. Let's take a look at where markets closed out the day. I'm looking at VU, TLT, GLD, and IBIT, right? This covers a lot of ground. VU is the S&P 500 ETF from Vanguard. I used to use SPY, Katie, but now I use VU because it's the biggest ETF in the world at 650 billion. Most people own it. Oh, look at this. It's down even more. So it looks like there was some buying at the close. That's a good sign. Treasuries also down. Again, tough for 60-40 investors when both your bonds and stocks are down. Gold and Bitcoin up. They're both happy. Bitcoin in particular, because it normally moves with stocks. Now it's up. That's a decoupling So interesting day, just a bad day overall for risk assets.
Yeah, absolutely. Let's take a look at some of the day's biggest movers on the individual stock level. A lot of interesting stories here, and we start with Constellation Brands. We've been talking about this one, of course. Constellation Brands sliding after the alcohol company cut its fiscal 2026 guidance. They're citing weak consumer demand, of course, shifting alcohol consumption trends. You can see that's worth a 6.6% decline. Kraft Heinz, this is an interesting one as well. Of course, we know that Kraft Heinz is going to split into two publicly traded companies. Warren Buffett, who helped organize this deal about a decade ago or so, expressing disappointment there. Shares down about 7%, and Lucid down almost 11% on this Tuesday. The EV company initiating a stock split might explain some of the weakness that you're seeing there. But our top story this hour is Wall Street, kicking off September on a sour note, with megacaps really dragging down the major averages. NVIDIA was leading the Magnificent Seven lower, with the chipmaker extending losses for a fourth consecutive session. That is its longest losing streak since March. Joining us now is Anurag Rana. He is Senior Analyst of Technology over at Bloomberg Intelligence. And Anurag, it's great to have you with us to help make sense of what we're seeing. In the case of NVIDIA, we finally got past earnings. There were some things that you could pick up, but overall, it seemed to go over not too poorly. What is going on with the Magnificent Seven as a whole right here as we flip the calendar into September?
Yeah, I think, one of the most important things we have to look forward is, what's going to happen with interest rates. When you look at the fundamentals of the sector, I mean, we are in really good shape when it comes to technology. There is no change to that. In fact, everything that we are reading when it comes to AI infrastructure spend, that seems to be okay. But we still have to look at the non-AI part of it. There are still some issues with that, but that impacts more companies like, Salesforce, Workday, Accenture, etc. But from a Mag 7 point of view, I think the fundamentals still remain good.
Yeah, and Anurag, a lot of people worry the Mag 7 is now 34% of the S&P 500. I dug into this, and I call it the Mag 70, because when you look, these companies have acquired 850 different companies. YouTube alone, which Google owns, would be the 19th biggest stock in America if it were spun off. You call them small countries. And should people just relax? There's all these articles about it's too overvalued, get out of this. Just seems like, why would you not want to own the best stocks doing the growthiest things?
No, you bring up a very good point, and we had a very long discussion on that topic. Another thing I would actually add is there aren't that many companies who can actually invest right now in the infrastructure boom so that they can see the benefits of it down the road. There aren't that many companies who can shell out $20, $50, $100 billion and have the free cash flow to back it up. I think is a fundamental difference between this build-out versus the internet build-out.
It's interesting, though. I mean, you think about the point that Eric's making, that you're speaking about. We were talking about this a little bit earlier, that it feels like tech companies are the last conglomerates. We know that spinoffs are very popular when it comes to almost every other industry. But could you see antitrust regulation coming in and actually successfully breaking these companies up?
I think that's always the risk with a lot of these companies, given the size and the breadth of what we have. But what we have seen over the last 6 months under the new administration is not as, I would say, as strict as the previous one was. So it just sounds a bit, I think, far-fetched at this point.
And let's talk about themes. My colleague Bree Doherty has a great thematic database. These Mag 7 stocks are all in like 6 to 8 different themes. So they qualify for all these really cool themes. The average stock is in one. Are they too overextended? Is that ever a risk for these companies?
See, we don't think so in terms of the business units, because it all comes back to some of their core businesses. So let's say if it's AWS, it's the cloud business. Whether they accelerate that growth using AI or quantum or any other emerging technology, it all comes back to that. Same thing for Microsoft Azure. It all goes back to their cloud platform. So a lot of what they're doing right now is helping companies embrace some of these emerging technologies, but at the end of the day, they are the ones who can fund this growth.
All right, Anurag, great to get some time with you. That is Anurag Rana of Bloomberg Intelligence. And we do have some breaking news here on this point, actually, that we were just talking about. Google not required to sell Chrome in a court antitrust ruling. Really interesting. Of course, we were just speaking about this, that you think about how many different things that these giant companies own. Sure, antitrust regulators could come in and say you have to sell it, but on the other side, it feels like they're smacked down more often than not.
Yeah, as long as the antitrust isn't an issue, they're good. Kate, I got to ask, is that the best timed headline you've ever had on the show? Okay.
Amazing. Definitely in
That's
recent memory. Yeah, it's nice when things work out, isn't it? In any case, Google shares up about 4.7% after hours right now. We'll continue to follow that story. But just to repeat, Google not required to sell Chrome in a court antitrust ruling. Meanwhile, let's turn back to the day that was and the month that will be, because investors bracing for September turbulence, historically the weakest month for U.S. stocks. Our next guest warns some potential seasonal weakness shouldn't be a surprise, but we wouldn't expect more than a 4 to 6% mild pullback. Ryan Detrick, he is Chief Market Strategist at the Carson Group, joins us now. Ryan, great to have you with us. I understand that September is painful more often than not, but you think back to May. You're supposed to sell in May and then go away. May was a fantastic month for the S&P 500. It feels like seasonality is fickle at best.
Well, you're right. First off, thanks for having me back, guys. Really appreciate the opportunity today. So we do know sell in May go away. I know we actually talked about why the likelihood of a surprise summer rally was there. We've had that, right? And you look at what happened the first day of August. We had a pretty weak day. Everybody said, oh, August is usually weak, and myself included, looking at potentially seasonals. But right now, if you look at some of the worries that we have, we do think after a 30% rally off those lows, maybe some normal, perfectly logical choppiness makes sense. You've got tech underperforming. You just talked about that before I came on. That could continue. We've got that jobs number on Friday, and I'll be honest, I don't know what is considered good or bad. Maybe we get better jobs data, and that pushes back on, potentially the rate cuts, and we've got inflation data coming up. So let's just be aware this is still a bull market, yes, but as everyone has talked about, I'm sure all over your network, September can be tricky, and I think maybe we could have that happen again.
Well, Ryan, to that point, that you could expect to see a 4 to 6% pullback, you would call that mild. Would it be tech mathematically that would lead that, or do you think that it's other areas of the market that would drag us there?
Great question. We think it would be tech. We are slightly overweight tech here. We'll be very clear, so we think it's going to be fairly minor. At the same time, what's been happening, right? The baton's been passed around. If you look at like advanced decline lines, how many sectors going higher? Yes, tech's been weak, but other groups are doing okay. I mean, energy is doing pretty well. Materials doing pretty well. They're much, much smaller, as we know. So that's why that equal weight S&P 500 has been hanging in there so well. One thing I think is interesting, I want to point this out. Today's 100 trading days off of the April 8th lows, so the lows before this rally. We're up over 25% in 100 trading days, one of the best 100-day trading days we've ever seen. I look back, guys, in history, only 11 times have you gained more than 25% in 100 days. Here's what I think the listeners need to know. 3 months later, never lower, okay? Up every single time 3 months later, and a year later, up 10 out of 11. So with better than average return. So what I'm getting at, the strength we've seen the past 100 trading days is not normal, but it is consistent with the bull market. But again, maybe some near-term indigestion makes sense. Any weakness will be contained, and we think we're still having an upward trajectory, though, in our view.
Ryan, I love following you on X because you are very optimistic. You take data that others would use and make negative, you make it positive. You've made people money if they followed you. There's been so many worries. Sell America, the tariffs, June gloom, the Moody's downgrade. They've been thrown at investors, and they've largely just ignored them. They keep buying. The market's doing fine. Are economists just living in a separate universe?
It feels like it there, Eric. You're right. I mean, we've had so much gloom and doom. I mean, this whole summer, all we've been told is how bad everything is, yet we're up 4 months in a row, right? And you think about, I mean, economists have a job to do, but as a message of the markets person, as a strategist who looks at the whole picture, that's why we look at fundamentals. That's why we look at sentiment. That's why we look at technicals. I mean, look at sentiment. I mean, I get to travel the country, talk to people. I never get the question, wow, this is really good. How high can this go? It's always how bad is it going to be? Because on TV or the radio, I heard all this different things that's going to be just terrible. The reality is the economy is slowing. Our economy is going to grow maybe 2.5% the second half of this year. That's not a recession. No, it's not the 3.5% we saw the last couple of years, Eric. But the reality is we're still chugging along pretty nicely. And I don't know, those economists, they can keep being bearish. We'll keep taking the other side, I guess.
All right, Ryan, unfortunately, we're up against the clock, but that's a great place to leave it. Great to get some time with you. That is Ryan Detrick. He is Chief Market Strategist over at the Carson Group. This is Bloomberg. Let's get back to that breaking news from Google. A court ruling they are not required to sell Chrome. Let's get to Mandeep Singh of Bloomberg Intelligence for more context here. You can see that the shares are spiking in the after hours, Mandeep. How surprising to see this is this?
It is surprising because Judge Mehta was in favor of divesting Chrome, which is the key asset here that everyone is looking at. And in this case, I think the ruling clearly states that they're not required to divest Chrome. At the same time, there won't be any exclusive contracts, so that means the Google-Apple thing won't be at least allowed anymore. And then also related to Android, there won't be any like licensing agreements that bar certain companies. So really, I think what it seems like is they are in favor of opening up the platform where other companies can bid, but there is no talk about, Google having to divest any of their assets.
It's amazing Google can go up 6% just like that, like it's a small cap. I mean, that's how powerful these stocks are. We talked to Anurag earlier about the other things Google owns, like YouTube would be like the 20th biggest stock if it were spun off. Could they go after other parts of Google in an antitrust way?
Not really. There were two big lawsuits. One was the monopoly lawsuit, where Chrome was the big asset that everyone was focused on. And look, the reason why you're seeing a 5-6% move is because when it comes to Chrome, over 3 billion monthly active users, AI agents, and everything that's going on in Gen AI, browser is the most important asset. So if they were restricted in some way, I mean, that would really hurt Alphabet's position in Gen AI. So from that perspective, it did warrant a big move like this.
And Mandeep, we have about a minute left. We're talking about Alphabet, but take a look at shares of Apple, up about 3.7% in the after hours trade as well. What can we extrapolate from this ruling into Apple?
So look, I mean, clearly the agreement that Apple had with Google is at least not allowed anymore, or that's what the ruling suggests. But Apple is looking to use someone else's model. So from that perspective, probably they could use Gemini or something related to Google to catch up to other companies when it comes to incorporating Gen AI. So from that perspective, I do think it's a positive that Apple can use something of Google going forward, and there are no kind of big restrictions that are evident.
All right, really appreciate your instant reaction there. That is Mandeep Singh of Bloomberg Intelligence. Now, coming up next, we'll turn back to eco, a tamer jobs number expected in that critical report due on Friday. We'll discuss with Betsey Stevenson of the University of Michigan up next. This is The Close. Well, we have a big week of economic data ahead of us as investors await Friday's jobs numbers, the last payrolls report until the Fed's next rate decision. Hot off the Bloomberg Opinion Press, columnist Allison Schrager writes, on paper, these are good times for the U.S. economy, but if the economy is so good, why does it feel so bad? I'm pleased to say that she joins us now on set, and let's start exactly there. Why do things feel a little bit worse than maybe the numbers would suggest?
I mean, this has been an extraordinary boom, and let's start the boom with the end of the pandemic recession. Remember the Vibe session?
I do.
It's like we've been complaining about this booming economy for like 4 years now. And part of it is inflation. Just like inflation is terrible, people hate inflation, real wages still haven't recovered, price levels still higher. So part of it's that we're just sort of negative creatures, and part of it is legitimate uncertainty.
Well, that's the thing. When it comes to inflation, maybe we're not seeing 9% when it comes to the rate of change, but the absolute level of prices is much higher than it was a couple years ago. And I feel like that's just a fact that is a fact. You can't get around that.
Yeah, and people aren't used to it. I mean, most of us have never experienced inflation before, so we're not like, all right, that's in the past, prices are higher, and I'll just move on. I think people still are largely sort of feeling like when they go to the grocery store, like 5 years ago, eggs weren't this much.
Yeah, I think, a lot of these bull markets are like the most hated. It just seems like negative creatures is part of it. Inflation being a silent tax, this has drawn a lot of people to the crypto world. They sense something is like they're not able to buy a house. And it is interesting. They are continuing to invest in stocks, though, which a lot of people say are the ultimate inflation hedge. So do you think some of that might offer some comfort that they're at least keeping up with inflation because the stocks are up?
Yeah, I think, 60% of Americans own stock, which is a lot. But it also feels risky. I feel like, people keep saying the stock market is overvalued, that it's frothy. I think that feeds into the uncertainty because, a lot of the growth is based on a few stocks. So I think people also just legitimately feel uneasy.
And you talk about boomers a lot. They have they own like 70% of the stock market. Mm-hmm. And they're going to pass it down. They're going to cash out. What do you think that will have an impact on this bull market? Could that demographic shift do anything?
It could. I don't know if they're going to cash out. Probably they'll just keep it in stocks and then leave it to their heirs. The research shows is that retirees generally don't spend down their assets unless they have a big health event. So, I think the concern with the stock market is that valuations are a little high, and when that happens, you just never know what brings.
Well, let's bring this conversation to the fixed income markets, because you also wrote a recent column, Can America Get Americans to Buy Its Bonds? Which is a great question to ask.
Yeah, I think where we're going, especially seeing higher rates on the long end, is a regime of financial repression, which it sounds bad, but like Europe and Japan have been doing it for a long time. Not that we should emulate what they do, but effectively that's when the government pressures, usually banks, to buy a lot of bonds. But in that column, I talked a lot about how the big bond buyers we're counting on are retirees. And effectively, that's the way repression is going to go, because people effectively buy in their retirement accounts what the government tells them to.
Yeah, there you have it. Allison, great to get some time with you. Really interesting columns. You can find her work on the Terminal and on Bloomberg.com. That is Allison Schrager of Bloomberg Opinion. And let's keep this conversation going on where the economy stands as we await Friday's jobs report. We'll do that with Betsey Stevenson. She is professor of economics and public policy over at the University of Michigan. Professor, fantastic to have you with us, especially at a time when it seems like the Fed's dual mandate is in opposition for the first time in quite a while. You have this situation where inflation not quite yet under control in the context of the Fed's target. And at the same time, there's a lot of worries right now about where we actually are in the labor markets and whether we're going to see a material weakening here.
That's right. To think about what's going on is we have really a form of a supply shock with the tariffs. So that supply shock is that it's just more expensive to buy goods from abroad. And I'm not just talking about, parents trying to buy back to school items for their kids, but companies trying to buy the inputs that they use that they might be sourcing from around the globe. And that, with everything getting a little bit more expensive, we're just going to, buy somewhat fewer things, right? And that includes businesses. Seeing their input costs going up might mean they need fewer employees. And there's another way in which we have kind of a supply shock going on, which is that we are really discouraging foreign-born workers, right? We're rounding up workers and sending them back to their home country, based on what kind of documentation the president wants to support right now. But it's not just thinking about undocumented workers, but it's also really discouraging people who might be coming in either to study or to work in a formal way. So that reduction has led some to estimate that net migration is actually negative. So we've lost 1 million people. So that's a shrinking of the economy. The challenge for the Fed is it can't fix that problem.
Yeah, well, that's the thing. You think about trying to make monetary policy in this environment, and it seems really difficult because, Betsey, some of the things that we're talking about when it comes to that shrinking of the labor market, you're taking some of the supply out of the equation. And what we're talking about with tariffs coming in for inflation and seeing those effects, you aren't quite seeing it at the big headline numbers. So what is the Fed to do here?
Yeah, so the bottom line for the Fed is when they see, if they see a number on Friday like 75,000 or even a number as low as 35,000, they have to ask themselves, is that due to a decrease in labor demand that we should try to stimulate, so trying to get businesses to demand more labor? Or is that because we've just sent a lot of workers away and so it's really about a decrease in labor supply? The last thing they want to do is stimulate hiring if labor supply is down, because that will just cause inflation. So it's a very, very tricky time for the Fed right now as they're navigating uncertain data that they're not even sure how to, what sort of a true baseline or stable economy looks like because the economy is changing so rapidly.
Look, I get a lot of these policies are, antagonistic towards economic growth and even stocks, but stocks are at nearly all-time highs. I feel as though investors look at it as a Trump put. Like at the end of the day, he wants economic growth, he wants stocks up, and that will put a natural hedge on these other policies. What do you think of that?
I don't think wanting is enough. That's what I tell my children as well. It's not enough to want it. You got to actually work in the right direction for it. But I do think you're seeing one thing that's helping the stock market is we can adjust the value of the U.S. dollar downward. So the stock market's up in U.S. dollar denominated terms, not so much if we priced it in a different currency or even gold. So it does protect a bit against inflation. I think if you're out there wondering why the stock market is rallying in the face of all this uncertainty, remember there's a lot more going on than government, like artificial intelligence is a potential real strong upside. And I think there's a lot of people hoping that that's what bails us all out in terms of economic growth.
Yeah, and I also think, generally people, especially stock owners, react when it's in their own lives. What do you think is the first thing? I know high prices might be starting to be that thing. What do you think they'll see first that will make them feel economic pain that might make them change direction on their investments?
Well, I think what they're going to see is they're going to see prices starting to tick up, and then they're going to see particularly their kids struggling to find a job. And or their kids or their grandkids, because you were talking about baby boomers before. And it's young people that I think are going to get hurt first in this labor market. And when you start to see signs that maybe people aren't getting work and prices are going up, things look a little shaky, that might make you question what, the future for these businesses will be when they're trying to sell to consumers who are facing higher prices and less work.
Yeah, it's an important point there. Anecdotally, it does feel like it's gotten a lot harder to find a job in this current labor market. But, Professor, you think about the numbers that we're going to get on Friday. Of course, we're going to focus on the headline. We're also going to focus in a big way on the revisions. That has become a very politicized point in this NFP release. And you think about the revisions that we've gotten suggesting that this labor market maybe isn't as strong as we've been thinking over the past 6 months or so.
It is true that when the labor market is weakening or strengthening, the revisions tend to go more in one direction than the other. Of course, if you knew for sure it was weakening, you could correct for that. But that's the problem, is that's the evidence you're getting that it's weakening. Look, if there's one message out there, I hope you're pushing to every company manager out there, it's get your forms in on time and report your data. Because what's happening with these revisions is that they're really not getting enough responses in the first month, and then they have all the responses by the third month. And so by the third month, we're seeing something that's really much more accurate, but it's 3 months later. So we'd like to get more accurate data in the first month, but that would require a substantial investment in terms of not shrinking the BLS, as has been happening over the last several months, but actually expanding its budget and giving it ability to develop new techniques to ensure that they're getting data faster and being able to get the most accurate responses out there.
Yeah, it's a good point that you think about the collection rate. Certainly, it's been hard to get those responses. Betsey Stevenson, she is professor of economics and public policy over at the University of Michigan. Great to get some time with you ahead of that jobs print coming on Friday. But let's take a look at some of the notable movers right now in after-hours trading. It was an ugly day in markets. A lot of green on this screen. However, Zscaler, of course, reported after the bell. Shares climbing right now as fourth quarter calculated billings hit a record high, driven by sales of AI products. You also have Alphabet and Apple moving higher. We did get some breaking news for Google, not required to sell Chrome in a court antitrust ruling. You can see that sending shares higher by nearly 7% in the after-hours trade. And Apple, too, moving off of that headline, up about 3%, Eric.
I know, and MAGS, which is all 7, the ETF, is up almost 2%.
Yeah.
We sometimes look at them as a team, one of them has a good day to pick up the other one, and they just carry on in positive territory once again.
Yeah, night and day, of course, the cash trade and what we're seeing after hours. We're going to talk about more earnings to come next. This is The Close on Bloomberg. We heard from President Trump in the last hour saying that he will appeal a Friday decision ruling his tariff policies illegal. The president doubling down on the idea that the U.S. is experiencing an economic emergency he aims to fix by addressing global trade imbalances. Let's bring in now Jonathan Lieber. He is U.S. Managing Director and Head of Research over at the Eurasia Group. Great to have you with us, Jonathan. So, of course, we've heard from the president saying that it would be a devastation for our country if this appeals court ruling was left in place, really trying to drive home the idea that the administration's view is that they do have the authority to do this because this is an emergency.
Yeah, and this is a question that I think we knew was going to get appealed all the way up to the Supreme Court all along. I think a lot of companies are hoping that the court rules against the president and in their favor, and in doing so, also refunds a lot of the tariffs that have been collected to date. And, I think it's really hard to read right now what the Supreme Court is going to do. In general, they've been very deferential to executive authority when questions of executive authority have come up. For example, the president's ability to fire members of independent commissions or his ability to deport people without giving them due process. But in this case, it's a question of congressional delegation of powers. And the lower courts have been arguing that Congress did not delegate all of these authorities to the president, to the executive branch, the way that Trump has been claiming. And so the Supreme Court has also, in other cases recently, been very deferential to Congress and in saying that the president, that they don't have the ability to defer these powers to the president. And that was one of the kind of keystones of the lower court ruling that this tariffs exist solely in the powers of the Congress. So the lower courts have been very skeptical of this expansion of power. The Supreme Court has been more deferential to the president. And I think probably this is a bit of a toss-up right now, depending on what happens at the Supreme Court.
Yeah, and we also heard the president saying that the stock market's down because the stock market needs tariffs. They want the tariffs. So a lot of different question marks here, Jonathan. I wonder how this is being received overseas. We know that the U.S. is engaged in negotiations to reach trade deals with a myriad of different countries right now. And to have this internal squabbling, this squabbling within the country, whether or not these are actually legal, I wonder what that does to the negotiating position.
Yeah, so far it doesn't seem to have done much. Most countries that the president has been trying to negotiate with have opened up these good faith negotiations and have made specific concessions to the United States, assuming that these tariffs would be, that the president had the power to impose these tariffs. What we suspect is that even if the courts overrule his ability to use IEEPA in the way that he's been using it, and that's the law that's in question right now, that the U.S. government has ample resources in order to fall back on, including Section 301 and Section 232, which are both trade acts that the president used a lot in his first term. And I think that U.S. trading partners also see those authorities and recognize that there are already these court-blessed channels that the president can use to impose tariffs on them. So even if IEEPA goes away, he's got backup options, and you better negotiate with the guy, otherwise you're going to face tariffs.
Right, and we, as investors see this ruling, I think there's generally a good reaction, like, okay, less tariffs, good for stocks, I'm happy. Let's say the Supreme Court rules against it, the tariffs stay in place. How much more could we see? Like, what percent through the tariff pain are we? If you're an investor, how much more should you brace for if they overturn the ruling?
So whether or not the ruling gets overturned, I think that we are past peak tariff volatility. And this has been an explicit goal of Treasury Secretary Scott Bessent, who said he wanted to have tariffs behind him by Labor Day. That was yesterday. We're not quite, the tariff uncertainty isn't quite entirely behind the U.S., but it's very clear the administration's goal is to cut a bunch of deals with most of their trading partners, giving most people a sense of certainty around what the tariffs rules will be going forward. And I think that we're basically 80 to 90% of the way there. There's some question marks about, Trump's threatening additional tariffs on China over magnets, and there will be continuing kind of ongoing tariffs and questions, of course, about the implementation of some of these deals. If it's not implemented implemented in the way the U.S. likes, you may see tariffs go back up. But I think for the most part, the volatility and the wild swings you've seen in tariff rates are behind us, and you can kind of almost take to the bank, within maybe 10 to 20% of the current rates. You can take that to the bank going forward.
Now, if Trump does have these health issues and has to play a softer role and do less, who is in position to maybe head up the tariff situation, and who stands to benefit from that, and what could that look like?
Well, Trump's health issues I think the speculation about that is going to go away now. I mean, I think the guy had a press conference today. He was clearly with it. He was very, very strong in the press conference. And, he seemed totally unaware that there were rumors swirling online about his health. And, who knows why he didn't make a public appearance for a week. But I think that now has been going to be put to rest. If something were to happen to him, I mean, he is advanced age for a U.S. president. J.D. Vance would probably be in the pole position in terms of driving policy inside the White House. Scott Bessent, of course, would have a big role in setting tariff policy. I think one thing you'd probably see is that the White House would become more susceptible to private sector lobbying around issues like tariffs, because without the president setting a strong direction of travel, then I think you're going to see kind of more of his advisors and staff going in different directions. But I don't think those health rumors are going to amount to much given the performance the president gave today.
Absolutely. Good point there, considering his appearance at the press conference today, maybe putting a kibosh on some of that speculation. Jonathan, great to get some time with you. That is Jonathan Lieber, U.S. Managing Director and Head of Research over at the Eurasia Group. Now, still ahead, what investors need to watch for over the next 24 hours, including Macy's results. We'll discuss next. This is Bloomberg. Well, earnings season never ends, and we have Macy's taking the stage tomorrow. Investors watching for any commentary around tariffs and the health of the consumer. Here to preview that report is Mary Ross-Gilbert of Bloomberg Intelligence. And you think about Macy's, it's had a pretty okay 3 months or so, down 18% year to date, Mary Ross. They need some good news. Are they going to get it tomorrow?
We'll see. They might. I mean, consensus is looking for sales to be down about 3.6%. And when we looked at the consumer transaction data, it kind of indicated that they could come in at, that level, down about 3.6%, maybe a little bit better. They're looking for comparable sales, which is really a better measure of their sales, to be off just 0.5%. And where we're really going to see strength is probably in the luxury units, particularly with Bloomingdale's. But for the Macy's brand, the real focus is going to be on the 350 go-forward stores and their performance, and in particular, the 125 stores that they've revitalized. And I can say by the store in our mall in Century City, that's one of the 125 stores that's been revitalized, and it looks really good. I've noticed the sales staff is more engaging now, and they brought in new brands that are more interesting and more exciting. So that could help to lift sales, and that's the kind of commentary we'll be looking for tomorrow.
Mary, I am a resident of Philadelphia, and the big Macy's store just closed like a couple months ago, and I just thought this is the Amazon effect. How do they fight that? That's what I assumed is the problem here. Do they have an online plan?
Well, actually, they have a very good online business, a digital business. It's very much omni-channel, and it's about somewhere around 30% of sales. But the key here is really, I think the department stores have been losing share primarily to off-price more so than Amazon, because Macy's, if you look at their core customer, it's really, and this is the brand, the Macy's brand, it's really that lower to middle income consumer. That's their core customer, and it makes up maybe 2/3 of their customer base. Now, they could be getting new customers as they're revitalizing the stores. We'll see if that happens.
Right. All right, Mary Ross, great preview. Appreciate the time. That is Mary Ross-Gilbert of Bloomberg Intelligence. And don't forget to tune in tomorrow for updates from Romaine Bostick's interview with the CEO of Macy's on the back of their latest earnings report. Looking forward to those numbers and that conversation. But that does it for us. Balance of Power is up next. Have a great evening. This is Bloomberg.